Welcome to video 5B on the tax benefit rule. Not exactly an accurate name because you'll see we're going to cover a little bit of basis in this video as well. All right, Homer decides he'd like to buy a new electric car. The purchase price is $40,000. He puts down $10,000 and then borrows, so finances the car for the remaining $30,000. And then he receives a manufacturer's rebate of $1,000. And then because it's an electric vehicle, he then receives an income tax credit of $7,500. And the question is, what is his income from these transactions?
You bought a car without consulting me?
I don't recall being consulted when you bought that hat.
I found this hat.
So the cash clearly doesn't create income, right? When you spend money, that's not income. Borrowing money, we now know, isn't gross income, right? Because there's no economic benefit. These rebates and the tax credit, there might be a temptation to treat that as income, but the way you treat that is as a reduction of the purchase price. So basically, it reduces his basis in the electric car. So when he gets the rebate for $1,000, it reduces his basis. When he gets the tax credit for $7,500, it reduces his basis. So there's actually no income reflected. Instead, it's just buried as part of his adjusted basis.
She'll go 300 hectares on a single tank of kerosene.
What country is this car from?
It no longer exists, but take her for a test drive, and you'll agree. Zagreb ebnym złotych diew. Put it in H!
Okay. So what if Homer decides he'd like to buy a new car for his business, purchase price $40,000, puts down 10, borrows 3, and in the following year finally picks up his manufacturer's rebate of $1,000? Well, this would be treated identically, but what if this is for his business? And so as a function of his business, we'll see later, in year 1, he deducts the entire cost of the auto. But then in year 2, the cost of the car is adjusted. Well, that makes a complete difference in terms of what we did when it was a personal car and what we're doing now. Because now what Homer has done is deducted $40,000 and then in the following year needs to reduce that $40,000. So when you recover amounts previously deducted, because expenditures are typically deducted in the year paid, then sometimes that reimbursement in the subsequent year has to be treated as income under what's known as the tax benefit rule. So when taxpayers receive a refund of an expenditure that was deducted in a prior year, they are required to include the amount in gross income, but only to the extent that the amount refunded actually reduced taxes in the year of the deduction.
Learn it, know it, live it.
So in this particular situation, I think it's safe to assume that Homer was able to deduct the entire cost of the auto, all $40,000. So when he gets that refund in the following year under the tax benefit rule, he's going to be required to include it in his income.
Our tireless safety engineers crash test over 1,000 cars a year.
Hey, wait! That's not a dummy!
This exhibit is closed.
Okay, so Springfield Nuclear Incorporated is an accrual-based taxpayer. And SNI has an accounts receivable that becomes worthless, aka the customer becomes insolvent, and so they're going to write off that bad debt expense in year 1 when the customer becomes insolvent. In year 2, the customer wins a lawsuit and comes into a bunch of money, and as a result, they pay off that old accounts receivable to SNI. Under the tax benefit rule, SNI would need to recognize income for the amount of the accounts receivable that was previously written off to bad debt expense. Okay, let's contrast that with Mo. So Mo is a cash basis taxpayer, and Mo has an accounts receivable that becomes worthless. But Mo, as a cash basis taxpayer, does not deduct bad debt because cash basis taxpayers, as we'll find, do not recognize accounts receivable as income. So in year 2, when the customer pays off the old accounts receivable to Mo, then Mo must recognize income in year 2. The classic case of the tax benefit rule results from the way individuals deduct the state income tax deduction as an itemized deduction. Now, this is solely an individual issue, and this is a business tax course. But because it's so common, even though I cover it in 503, we're going to cover it again in 332. Okay. So before we even get started, we need to understand, for those of you that are new to tax, how the state income tax deduction works. So we'll start there. So state income taxes are deductible by individuals that choose to itemize their deductions, as opposed to a taxpayer who takes the standard deduction. Okay, the Lenovo advantage. So the taxpayer amounts the deduct that is paid during the year. And although that is now limited to $10,000, neither here nor there. Okay, so Ned is a wage earner. He has $5,000 of California state income taxes withheld from his paycheck in 2018. And having state taxes withheld from your paycheck is equivalent to you paying those taxes. So as a result, Ned itemizes his deductions in 2018. The total amount of his itemized deductions, so his state income taxes and his property taxes and his mortgage interest and his charitable deductions, whatever else he might have, is $16,000. So that's $4,000 in excess of the $12,000 standard deduction. So, and again, that $16,000 includes Ned's $5,000 state income taxes paid. On April 2019, like most taxpayers, Ned's going to file his California state income tax return. And when he does so, he determines that his actual tax liability isn't $5,000, that he was over withheld, which is very common, and instead it was only $4,500, and he's due a refund of $500. So this is good news. About a month later, California issues Ned the refund for $500. Because Ned enjoyed the benefit of that $4,000 deduction, of which there was $5,000 for state taxes, but remember, he only exceeded the standard deduction by 4. But because he did enjoy the benefit of that deduction, he must now include that $500 refund in his income under the tax benefit rule. Okay, let's do another example. So in this case, Ned is a wage earner and has $9,000 of California state income taxes withheld from his paycheck. So again, treat it as if he paid $9,000 of California state income taxes in 2018. But this time, Ned takes the $12,000 standard deduction. So when he files his tax return, he determines that he's due a refund of $500. That all sounds familiar. A month later, California issues Ned the refund. But in this case, because Ned did not enjoy the benefit of that state income tax deduction, because he only took the standard deduction, he is not required to include that $500 refund in his income under the tax benefit rule. He received no tax benefit. Okay, one last version, and then I promise we're done. So Ned is a wage earner. He has $3,000 of California state income taxes withheld from his paycheck, again, treated as paid. He takes itemized deductions of $12,900. So in this case, he's only $900 more than the standard deduction. Files his California return, determines he's due a refund of $1,000. So for whatever reason, and it's not realistic, but he way over withheld on his California taxes. When they issue him that refund of $1,000, because Ned enjoyed the benefit of only a $900 deduction. Notice that the only amount of the state income tax that was above his standard deduction was the $900. He's only required to include $900 of the $1,000 refund in his income in 2019 under the tax benefit rule.
So, Flanders, what do you think of the house that Love built? Oh, shoot.
Now, calm down, diddly 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 diddly. They did their best, shoddly iddly iddly diddly. Gotta be nice, hostility diddly biddly diddly. Ah, hell, diddly ding dong crap! Can't you morons do anything right?
That brings us to the end of video 5B. Thanks for watching.
What do we have here? The long, flabby arm of the law? The last case you got to the bottom of was a case of Malamars!
Malamars, oh, that's going in the act.